Hi, I'm Paul Heinze, Goldberg Heinze Business Advisors.
And I'm Al Kutchins of KRD, previously Kutchins, Robbins, and Diamond, certified public accountants.
We're back again, and this is episode 4 in a lineage of conversations that Al and I have had about the topic, the general topic of preparing to sell your business. And we've covered a number of different topics and areas of interest to most of you. And we encourage you to go back to early episodes if you've missed any. And you can find them on Al's site at krdcpas.com or goldbergheinze.com or the Heinze-Sight on YouTube. We invite your questions, we invite your feedback, and we invite your input. Today, we're going to talk about the methods of selling what you're going to be selling. The whole company, part of the company. Are you going to be selling assets? Will you be selling stock? Different ways of doing it, ways of getting your money, ways of completing a transaction. Al, please start us off.
Thanks, Paul. So just a caveat that in all the transactions that Paul and I have participated in, no two are alike. So the information that we give you is an overview, but each purchase or sale is going to be like a different child. They all have their own personalities. Some are well behaved, others are a little bit rambunctious. So, you never know exactly what you're going to get. So in episode 1, we covered the softer issues of dealing with co-owners, family, and key employees. And then we moved into some of the harder issues of actually preparing your business for sale to make sure that you're doing everything to increase your EBITDA. And then in the third episode, we kind of touched on making sure that your financial systems are upgraded and that your outside reporting is, all in order to give greater degree of confidence to the prospective buyer that the information being presented is true and accurate. So today, as Paul said, we're going to start about the many aspects involved in how the actual sale is structured. And we're going to do some interactive dialogue as we go along because we each have different experiences. I am looking more from the financial side, and Paul is normally representing either the buyer or the seller. So we have slightly different perspectives on things.
Yes.
Go ahead, Paul.
One of the first things, the very, very first area of topics in a business, and you're selling the business, more than one owner. It's absolutely essential that you get a resolution, a corporate resolution from your attorney that indicates that all of the shareholders are united in their desire and interest, authorization to sell the business. The simplest example of a problem there is when you go down the road and you're almost completed with the transaction and a minority shareholder says, wait a minute, I'm not ready to sell. Then you can imagine all of the complexities that would occur. So get a uniform expression of consent in a formalized fashion. I just wanted to begin with that, Al, because it happens. There's so many issues that can happen if you don't.
So let's take that one step further, and then we'll go back to the topics. And this really goes back to the first session, is you need to share that with your family, your wife and your kids. Yes. So everybody knows what's happening, because you're going to need their support, because when we get to episode 6, we're going to talk to post-sale. and you're gonna really need the family buy-in to help you on this transition.
Right.
So the simplest sale is I buy 100% of your stock.
Mhm.
Now, if we really wanted to make it very easy, you can endorse your stock certificate over to me. I give you a check. We're done.
Yeah.
Rarely ever happens like that. There's issues with buying stock, both for the buyer and the seller. The most pressing one for the seller is selling stock is great. He's going to get long-term capital gains, and all the liabilities related to the company move with the company.
Okay.
So, for the seller, that is great. For the buyer, you have some opposite issues, is that if you're getting stock, you're not necessarily getting a step up in basis. So you're paying a lot of money, and in most cases that I've seen, probably half of the purchase price is related to goodwill because the assets have been depreciated inside the entity. So if you're buying stock, you have what's called outside basis, and that doesn't give you any current write-offs for tax purposes. So there's usually some meaningful negotiations in coming to a halfway point where the price is reduced for the buyer because he's not getting the write-offs, and the tax cost is going up for the seller.
Mhm.
So that's if it's a C corporation. If it's a partnership, an LLC, or an S corporation, there are provisions within the tax code so that you can get a step up in basis in the assets or amortize the goodwill over a 15-year period. But again, it comes at a slightly higher tax cost for the seller. And, we usually are able to work that out. Now,
The
yep, go ahead.
expected form then of the sale probably is going to be an asset or select asset basis. Okay. And in
Correct.
that, I'll just mention initially and ask Al to follow that in a select asset transaction, some things are not sold, which is it's kind of important for you to know now that when you're selling your company on a select asset basis, because the stock isn't being sold, you still have a corporation. However, the buyer is buying the name and buying all of the website and all the contact information and facilities, as well as the manufacturing equipment or formulas and so forth. Probably they're not buying the cash. They may, unlikely. They probably are not buying the receivables. Sometimes they do. Certainly not the payables most of the time. Sometimes the bank debt is included. Sometimes it's not. So let's rewind to where Al started this episode. Every transaction is different. Okay. Now you see why it's so important for you to get your house in order initially, because you're going to be walking down a pathway now of uncommon and unfamiliar complexity. And so with the guidance of your accountant and the guidance of your attorney, perhaps a broker or advisor to go along with you, you need to be responsive and have your hands on most things. Would you embellish that, Al?
Yeah, so let's talk about three of the points you made, Paul, is what in the asset sale that you're describing, that most often happens when you're like buying a division or a product line of a company versus the whole company.
Mhm.
And Paul's right about cash, because you don't necessarily want to go to the bank to borrow money to buy cash, although you are going to need working capital to run the business. So that is kind of tied with accounts receivable. In a number of the service businesses that we've seen sold, what we've worked out is that the buyer collects the existing accounts receivable, gets a small commission for the effort of collecting them, and then remits them once a month or quarter to the seller. Because if he's taking over the name and the relationships, it'd be very confusing to the customer, to send one check to the old company, another check to the new company. So from a practical standpoint, that's what we've seen done. But those two items, the cash, the receivables, and Paul also mentioned the payable and bank debt. Most of the time, we see bank debt being required to be paid off at closing, and normally the buyer is replacing it with new bank debt. And there's often what's called a working capital computation. And this is an area where there's a lot of post-sale activity. So the easiest item is cash. You reconcile the bank, it includes the checks you've written, you know how much cash there is. But as we've talked about in an earlier episode, the odds are not all of your accounts receivable are collectible. That there's some dogs in there, either for product dispute, price dispute. And so normally there's a reserve held back on that. And in a larger sale, often an escrow is used either with the attorney representing the buyer or the seller, so that if you have $500,000 in receivables and the agreement is only $450 are collectible, $50,000 is held in the escrow account for 6 months or a year. If they're collected, it's released to the seller. If they're not collected, it's released to the buyer.
Right.
And similar happens with inventory, because as we also talked about, not all inventory is good. If the buyer isn't able to sell it within a year, it's probably not going to sell at all. So that's another item that's often reserved for through an escrow. There's also, if it's a manufacturing company, there's often reserves for warranty and product liability. And a lot of times this liability isn't recorded in the balance sheet unless you're getting reviewed or audited financial statements, because it's not done otherwise. And that will often carry for 2 or 3 years in a escrow account, because for extended warranties. Now, an interesting situation has come up that I'm going to a seminar in a few weeks on a new insurance product that covers reps and warranties. And This is an area where we've seen a lot of legal back and forth because the seller's attorney is trying to make sure that the buyer doesn't come back against the seller, and the buyer wants to make sure that everything he's purchasing is free and clear and such. So I'm probably in one of the next episodes, I'll report on what I think of the reps and warranty insurance, but it's a new product.
Along those lines,
So, yes,
the
sir.
couple of things need to be inserted here, Al. I think most people can identify their equipment, plant machinery and equipment, or the substance, the hard materials in their business that they're selling, the inventory, finished goods, and so forth. Please remember to consider intangible assets, things that have no form and substance, but they're there in the presence and affects the day-to-day or annual operation of the business. You have, and we're not going to talk too much about goodwill at this point, but we're going to mention it because everyone has read an article about goodwill, and we want to mention a few words about that. Formulae, things that are private, things that are important, critical to the business in terms of intellectual property, copyrights, patents, things that are proprietary to the business, owned by the business, and make a material contribution to the profitability and day-to-day operation. Be aware of what you might have to add to the value of your business along those lines, or not. Maybe there's nothing. Your phone number and your name, which gets into the area of goodwill. Would you comment briefly on the
well, you also mentioned website and domain and things like that are becoming more important in commerce every day, as we've seen. Your customer list is another intangible, and your vendor relations. And I want to talk about that for a minute, and what will end up happening is in the next episode, we'll talk about various financing methods, because Paul and I like to share our knowledge, and there's a lot accumulated, so we usually don't get to everything we want. But your customer contracts are very important, and your vendor sources. And today, a lot of companies are not adding new vendors to their records. And that might be one reason why you end up buying the stock of the company versus the assets, because you stay as the vendor of record, because it normally moves with the employer identification number. So if you take over the corporation, you take over the employer identification number, and normally it's seamless. That I haven't seen very many due on sale in vendor relationships.
The contracts of bigger companies make it emphatically clear that the order was given to such and such a company, and it is not transferable to a new buyer. And there have been situations, things that we've been involved in, when the seller realizes that he's really not selling customers because the important programs that he was producing have to stop with him. And the new owner has to be completely recertified and approved for the reasons that Al just mentioned.
And another thing that Paul and I represent a lot of manufacturing companies. And if you think you're gonna just pick up and move their presses to your new location, you're in for a big surprise. Besides the cost of moving the equipment, your customers are going to have to come in and go through your PPAP process to make sure that everything is still running in the same manner. So one of the things that when you're the buyer is looking for is often to more effectively utilize their space, and it's relocating the equipment and getting the approval process from your customers. It can take many months and really disrupt your cash flow and your production processes.
I want to repunctuate something. We've just redefined, Al has just redefined the reason that you establish enough planning time before you sell the cluster of the biggest group of assets that you have, most of your wealth, possibly, by doing it in a planned, organized, and effective manner. You can get ambushed just from what Al was talking about if you don't pay attention to the consequential impact of what your good long-term customers may say. They may devalue what you'll be getting for your business because they won't guarantee that they'll do business with the new owner. Not good, okay?
Excellent point. So this really takes us through maybe the first half of the letter of intent. The second half, I think, will be smarter if we cover in the next episode, dealing with the financing, seller notes, earnouts, installment sales, and things like that from the financing aspect. Does that work for you, Paul?
Absolutely, and I would add to that, Al, that we encourage the viewer to contact us for very specific cases that they're facing personally, or if they're just beginning to cross the threshold of acquiring a company or selling a company, and they're looking for some navigation, some assistance or guidance, we would be happy to get them started in the right way. Because you're on a narrow road. In some cases, it could be called walking the edge of a razor blade. You have great intentions and you see the end game, but the mechanism of getting there is a process that is careful, and you really need to surround yourself with people who have experience, who want to support you, and the people that you can trust. So any closing remarks at this moment, Al?
Yeah, it's even become more stressful the last 3 months with interest rates going up. So if you started negotiating at the beginning of the year when we were at 1 or 2% interest rates, and we anticipate another 0.75% increase this month or next month, it's made the cost of your acquisition more expensive, and you really need to sit with your advisors and reassess if there's going to be adequate cash flow to sustain the increased debt service costs.
Right. On that cheerful note and accurate assessment, I'm Paul Heinze, and Al Kutchins is with me. Please be prepared to see episode 5, which will be coming your way soon. You can reach us, goldbergheinz.com, KRD CPAs, located in Schaumburg. We'd be glad to give you our opinion on things that you might be concerned about. Until then, thanks for listening.
It was a pleasure talking to you and our audience, and hopefully feel free to reach out to either of us and tap into our vast knowledge.
Absolutely. Good to talk to you all. See you soon. Bye for now.
Thanks. Have a good one.